Investors, listen up. By 2026, a massive mortgage crackdown will fundamentally change everything. Canada's banking regulator is buckling down on mortgage fraud and risky loans. And blanket appraisals are exactly that. Inflated mortgages that allow banks to push through more deals. The rules are shifting right now, and if you get caught unaware, this crackdown could cause huge problems for investors and homeowners alike. Here's everything you need to know about the looming changes. Hi, my name is Zen. If you enjoy my data-driven and number-crunching real estate updates, be sure to like and subscribe. Blanket appraisals, and blanket appraisals. A lot of people have been talking about it. I've talked about it in the past before, but I want to make an official video about the blanket appraisals and how this is basically borderline fraud that some of these banks are committing. So OSFI, which is the banking regulators, so they're like the people who make sure the banks are, confining to certain rules and not making things risky, right, in the housing market because there's too many bad loans. It could be like great financial crisis level kind of events. So OSFI has stated that they are aware of the blanket appraisals obtained during pre-construction. And you have to understand the reason why this product exists right now in this market. Because if you show me an incentive, I'll show you the outcome. So for the incentive for a lot of the banks who are providing this, and they're only really one or two, these banks are providing it because they have an incentive to see the building close so that their construction loan or mezzanine loan or some kind of loan that's on that, call it pre-construction project, actually closes and they have all their loans paid out and spread out through, say, like 300-400 investors / speculators so that they are not on the hook for all the mortgage for this one giant title. So they're effectively spreading the risks. And the reason why I'm emphasizing / speculators is there are a lot of people who bought pre-construction only with the idea of flipping the contract, but now they're caught in the middle of it where they can't actually flip the contract unless they're paying someone to take the contract off their hands. So they're basically left holding the bag and being cash flow negative by quite a lot of money. And the reason they want this right now is, one, they may not have the money to cover the gap between what the condo is worth or the house is worth relative to what it is worth right now. And it's that change in price from when they bought it to now, because the market has come down, that OSFI is flagging. And that's exactly why these investors / speculators want blanket appraisals, because without it, they're going to basically be sued by the builder and they're going to default. This is the saving grace that's kind of keeping the Jenga block of a condo building or subdivision from collapsing completely. And here's OSFI's take on this. Also, if it results in uninsured mortgage loans, so these are mortgages with 20% down, that exceed 80% of the market value of the property at the time of loan origination, this would not align with legislative requirements. But it's clearly not cool by them, but obviously it is still happening right now. So I would expect there are going to be some kind of changes happening to blanket appraisals in 2026 because there's quite a bit of uproar and saying, hey, this is a lot of risk that a lot of people are taking. And there's a very key point that I want to point out that not everyone may be catching on to is that if the loans exceed 80% of the market value. So in layman's terms, it basically means this. If you bought the property for $100, you're going to get $80 of mortgage on it, but because the market has come down 20-25%, or if you bought a pre-construction, maybe you bought at a premium, so it's down 30-40%, that means that your property is no longer worth $100, it's worth $60, and therefore the loan of $80 is greater than it. It is actually not on side. So therefore, this does not align with legislative requirements, so it is a risk. Now, this next paragraph is my interpretation where they're kind of backpedaling, saying, hey, yes, this is happening, but it's not that big of a deal, where they're saying 1.2 of mortgage originations were to purchase newly built condos. And as of February 2025, so earlier this year, 1.4% of that outstanding mortgages were used to fund newly built condo purchases. So all they're saying is basically only a small 1% fraction of mortgages is in this, call it blanket appraisal category. But it's still a lot, because we have to remember, while 2022 was a lot of condo completions, 2026 in 2 months or so is also the second most amount of completions. But the biggest thing here is that the completions in 2026, 2027, and 2028 were bought at the peak of the market in 2021 and 2022, meaning the premium they paid on it is even higher, which tells me that there's going to be a larger uptake in these blanket appraisals. And maybe this is exactly why the banking regulators are coming down on this next year, to prevent a lot of risky mortgages. Hey, it's me interrupting myself. Ready to make a move? Just one free call, no hassle, but decades of experience to work for you. And there's an interesting piece that I've highlighted in this article that I'll read for you that I find really hilarious, but it just is an anecdote to show you how bad and how great blanket appraisals can be at the same time as this. Coincidentally, right now, there's also been a lot of under construction homes that have become frequent targets of arson, so properties being set on fire. And because of this, no completion means no closings and no need to secure financing. However, on the upside, the suspected arson of new homes under construction has tapered with the rise of blanket appraisals. Funny. The timing isn't a coincidence. A piece in the Star earlier this year openly stated that blanket appraisals are being used to keep deals from collapsing. And instead of using current values, major banks like RBC are backing loans on the purchase price, a problem even the regulators have acknowledged, which is what this piece was talking about right here. And even though OSFI has flagged it as a concern, what I can tell you is working with my mortgage brokers, they still do exist. They are still being underwritten. So I would warn you, if you're an investor slash speculator or someone who owns a pre-construction that does not have a blanket appraisal on your property, I would recommend you go get one right now on the off chance that it changes. Because from my understanding, if it's underwritten, it will be honored. But if you're going to go ask for it after OSFI has cracked down on it, you're not going to get it. And that could spell a lot of hurt for you. And the reason why I think OSFI will nip this in the butt is you can see their response. Any valuation, whether based on blanket appraisal or otherwise, that does not reflect the current price level, which means we're down 25 from the peak or like 40, 50, depending on which pre-construction project you bought them, at the time of mortgage origination would not meet these expectations. When we see lending practices that may be inconsistent with our expectations or applicable law, we act to clarify our expectations with institutions so that they can take corrective action. And these corrective actions may come in 2026. So this is my PSA. If you do not have a blanket appraisal right now for your pre-construction closing in the next few years, go get one. Protect yourself. And speaking of 2026, they are also going to be changing some guidelines for how you can get investment properties. Now, some of these proposed changes will be changing the way that investors get their mortgages. And it's not to say that you can't get mortgages as an investor anymore. It's just they're making it harder to qualify. And I've seen a lot of these changes dating all the way back to 2008 because they will make borrowing harder and harder. And that's just how it works because they're trying to restrict a lot of investors from getting in the market. And it's not a bad thing. So this is one of the things that they are proposing to change. When rental income accounts for more than 50% of the mortgage qualifying income, this classification denotes a higher risk resulting in higher costs for lenders who will pass these costs on to borrowers through increased interest rate and stricter terms. So that is a lot of mumbo jumbo and just technical talk, but let me just break it down for you in layman's term. What OSFI is basically saying is, hey, if you're gonna be lending mortgages out as like the banks, like RBC, TD, whatever, we are gonna deem the amount of money you lend out to these investors as riskier. So therefore, the amount of money you need to hold on reserve to lend out this money is gonna cost you more. So traditionally, let's say the banks, for every dollar they hold in deposit, they can lend out 10. So that's what we call rehypothecating the dollar. Now, if they were to do 1 to 10 for end users, that's what we have right now, that's perfectly fine. But maybe because they're deeming these investor mortgages as higher risk, maybe every dollar they hold, maybe they can only lend out $5. So therefore, the incentive on the banks is to lend out less of these mortgages to investors because they can't lend out as much, therefore their profits are lower. So to offset that, they're basically going to be increasing the cost for a mortgage that you're putting as an investor mortgage. So an example would be like if you buy a triplex and you plan to rent out 2 of the units in the triplex, that's more than 50% of the qualifying income. So what this is basically doing is it's tightening the ability for investors to get mortgages. If you ask me personally, I don't think it's that big of a change, but we'll see what kind of rules the banks are going to implement. Because if you're going to go buy a rental property and you actually say it's an investment property, you're actually already charged 25 bips or 0.25% more on your mortgage for that risk anyways. Granted, a lot of people say they are an end user anyways. Now, the second one is more difficult to qualify for mortgages. And I would say this is more for real investors that are cash flow investors that are either adding multiple units in Toronto or they're investing in smaller towns where cash flow is better, so your cap rates are higher. And what they're basically doing is the most consequential change prohibits double counting income streams. So when building a portfolio, we often use existing rental income saying, hey, this is how much income the entire portfolio generates. And we usually use something called DSCR, which is the debt coverage service ratio. But it sounds like they're not allowing the double counting of that. So you're going to be using and relying on your existing income, your personal income, whether it be your job or your business, and you cannot use your other properties to qualify for another property. I can already tell you low key with rents coming down and rates going up, that really hasn't worked too much in the past few years. So I find it very weird and also counter-cyclical that OSFI is coming down with these rules for restricting investor mortgages when really they should have done this in 2021. So they're either very slow to react, which is what I think is the case, or they're preparing for a massive investor bull run in the next few years. I don't think it's the latter. And a good way to kind of look at the second change is like, instead of having one master key, which is all your income that opens up different doors, you basically have one key per one door. So you have to use that particular property's income to qualify. So it will be harder. Granted, there's always workarounds, and it just maybe larger institutions that are regulated by OSFI can't provide this, but there will always be like secondary mortgage providers through MICs or private lenders that will actually be like, oh, hey, this is another source of revenue stream for those high cash flow investment portfolios, right? So it's not a end all be all, that it's just gonna be harder to be an investor. But ultimately, I still think it's hard to be an investor right now because a lot of the economics and the math doesn't really make sense to be one, and there's really bad sentiment going on right now. Because instead of talking about creating large portfolios and lots of income coming in to diversify your income, a lot of the narratives right now and headlines are talking about how a lot of people are underwater and the value of their mortgage is greater than the value of their homes, so they can't even sell. And that's exactly what I talk about in this video right here. So make sure to check it out. Until next time, your move, your future. See ya.